Welcome to episode 53 of Kontrarian Korner. I'm Ben Kelleran. Today we have a very special guest on to talk with us about economic policy versus economic statecraft, some of the geopolitical events going on, and basically going to take a look at everything from 30,000 feet to see what everyone should be paying attention to. I think it'll be a very interesting conversation. We'll obviously talk about how all this stuff ties into the financial markets, but he's a global strategist at Rabobank, and I'm very excited to have him on to chat today. So, Michael Every, thanks for coming on to the podcast.
Thank you for having me, and happy to be anywhere with the word contrarian in the title.
Yeah, so I think hasn't been a whole lot happening lately, so I figure I would just toss it over to you to see where you want to start, because I think I guess the way I'll open it up is, what do you have at the top of your radar right now? What is the main thing to focus on? What is the biggest item that you think people should be aware of as far as everything going on right now?
Sure. Well, I keep trying to express the same thing in different ways, and I'm going to try and express it a different way with you again to simplify it, which is effectively that if you imagine the world economy and the world political system and the world security system was all one big jigsaw, which had been carefully laid out on the table in front of us like a world map with all the pieces, pretty much interlocking together. Maybe there's one piece missing here, one piece missing there, or one that's the wrong shape that's been hammered in a bit hard. But generally speaking, the puzzle is complete. Well, right now, someone has taken the entire tabletop, thrown the entire jigsaw up into the air, and it's all going to come down again, and we're not quite sure what it will look like when it comes down, because the pattern that we were trying to make, or the picture we were trying to make when it was on the table before, was what I call because markets, where everything was about what's cheapest. And as it comes back down, it's going to be about because national security, where markets are still important, but markets are subsidiary to what that national security impulse is. And that means the map will look very, very different. And until we understand what it will look like, everything is in flux.
Yeah, I think that's a good way to look at it. I think there are a lot of things changing. I think the way I'd put it is, people seem to be missing some of the big picture changes going on. And I know that's where you kind of talk about the economic policy versus economic statecraft. But I think with what's going on with Trump, and maybe we can get into U.S. and China specifically, because that seems to be a target of a lot of the recent actions and a lot of the recent narrative. The way I kind of frame it is, on one hand, you've got like the tug of war between the U.S. and China, where the U.S. it has become reliant on Chinese supply chains, and they also rely on Chinese debt markets. But at the same time, you have the Chinese economy that relies on the U.S. consumer. And so I think that's kind of a big part of the tug of war going on. But there's obviously other stuff going on, whether it's like fentanyl and other things that are not specifically economic problems, but definitely, I think, a part of what's going on. So maybe if you have any thoughts on U.S. and China, some of the recent developments, and where you think that might head over the next, say, 3 to 6 months, I think that'd be a good place to really get into it.
Sure. Well, look, obviously the US is the world's largest economy. China is the world's second largest economy. And the two have become deeply integrated in terms of physical supply chains over the past couple of decades. Everyone recognizes that fact. Therefore, product after product, whether it's a consumer product or even one that the Pentagon relies on, has China deeply embedded in that supply chain somewhere. And on the other hand, while the Chinese economy doesn't absolutely rely on the US, it isn't an export-dependent economy in the way that like a small emerging market would be. It's actually an investment-driven economy, far more. But a lot of that investment does end up in exports. So China does still need to have someone to sell everything to, because it, as an economy, produces too much. And you may think, well, how can you produce too much? Well, that's what a trade surplus is. If you can't consume it all at home, you've made too much of it. And you have to find someone to sell it to, which is the other country's trade deficit. So from an economic perspective, the two need each other. There's perfect synergy between them. And anyone attempting to rock that boat is a fool. From a national security perspective, or an economic statecraft perspective, that's a dangerous over-reliance of both on the other, and for the US, probably more than China, which is incompatible with the roles that both countries see themselves playing globally in the longer term. Ergo, we are where we are. Now, where will we be 3 to 6 months from now? Obviously, very hard to tell, because both sides have got a very, very different vision of where they would like it to be, as well as a fallback option. China would like everything to go back to the way it was, where the financial markets punished Donald Trump enough that he realizes, I shouldn't dare rock the boat, because markets, which is the mantra, as I was just saying, everyone thinks rules. We go back to quote unquote normal, which of course is a glide path to China dominating every key industrial sector and every key technology, and the US gradually and then more rapidly declining from its global top spot in field after field, and eventually in security, and eventually as the global hegemon. So that's what China would obviously want to see in the longer run. From the US perspective, of course, they want to try and get manufacturing back, to force China to consume more, to rebalance the world economy, and to create an entirely different global financial and trading architecture, which will affect absolutely everything, everywhere. If they can't get it, and they will not get that within 3 to 6 months, whatever happens, they're being very clear. They're doing what I said they would do months ago, because the logic was very, very clear to me too. They will try to create as large a trading bloc as possible, absent China, to show China that effectively the world can carry on without them, albeit with a painful transition. So they'll try and get India, Japan, South Korea, Australia, New Zealand, the Philippines, obviously Canada and Mexico, that goes without saying, the UK, Saudi Arabia, the UAE, a couple of others, all linked into a US network. Now, they'd like Europe too, but Europe's a swing vote. But if they get that coalition together with a common external tariff against China to say, look, play by our rules, stop overproducing, run a market economy rather than a command economy or a semi-command economy. And if you do that, you're in, and if not, you're out. You will bifurcate the world. I don't think we'll be there in 3 to 6 months, but I think we'll be heading towards it, or we'll be moving much closer towards it, because it seems extremely unlikely that China is going to agree to the terms that the US is attempting to set for it. So that's my guess, but I don't make specific forecasts because no one knows exactly what will happen. What I do is try and create logic frameworks, like balance sheet accounting identities, where it can only be this or that. And then it's up to everyone listening to decide which one they think is more likely, but it's going to have to be either this or that.
Yeah, I think to your point, I've talked to a couple of their guests, and they've talked about a kind of soft iron curtain, in effect, kind of going up between China and the rest of the world. And that bifurcation that you're talking about, I think, is an interesting way to look at it, because like you said, I think it's really hard to game out how this all comes to a resolution, or if it comes to a resolution. But the big picture theme that I think is a durable trend is deglobalization is going to be something that's going on for years to come. And typically that's on the inflationary side of things, and that kind of feeds into different parts of financial markets and different stuff going on there. But as far as any specific impact of kind of US-China relations, how do you think that feeds into financial markets, whether it's bonds, commodities, equities? I know the last month, give or take, has basically just been a giant whipsaw between headlines from Trump or Percent or whoever's talking most recently. But how do you kind of think the US-China situation feeds into where financial markets might go?
Well, I've made this analogy before, or I've drawn this analogy before, and I'll do it again. Most of the people that I talk to in markets, with a few very honorable exceptions, remind me of a class that was still around when I was a younger man, which were the apparatchiks who used to run the Soviet Union, who were normally very well educated. They were often engineers, scientists, PhDs. So extremely intelligent individuals, capable of complex thinking, but working within a system which was clearly failing, which the Soviet system was, a command economy. Couldn't work. You couldn't reform it and keep it a command economy. And yet none of them could quite conceive of what was lying on the other side of it, which was a complete chaos that we saw with the collapse of the Soviet bloc and the rapid, painful reinvention of a market economy on top of the rubble of a Soviet one. And suddenly people who had, as I said, PhDs in engineering, who had been running things, either became very dodgy characters who made billions overnight by snapping up assets on the dollar from people who understood less than them, or they lost all their power and influence, and then they're, just twiddling their thumbs in impotent rage as everything they'd spent their life working for collapsed around them. Now, that's a bit of a strong parallel. I don't think we're going anywhere quite as dramatic as that. But we have 45 years worth of institutional memory in financial markets, which thinks they're the single most important thing on earth. The press lionizes them. Everyone talks about them. We have a specific financial press that just spouts its own self-serving nonsense over and over again, with, again, a few honorable exceptions who are prepared to speak truth to power. And of course, they're not taking what's going on very well. There's a staggering degree of denial. I mean, we're recording this on a Friday. And in this week that's just passed, we have seen a staggering number of outright misrepresentations of reality, deliberate distortions, and selective editing of events and statements to try and support the fact that President Trump has been walking back US tariffs, which he hasn't in the slightest. Now, he may do. I'm not saying he will or won't do that in the future. But even if he were to do it, it's going to be still to an incredibly high level. Like if we go down from China from 145 to 60, that's a level people would have had a heart attack about 12 months ago contemplating. And now they'll accept it with relief, which maybe points to part of his strategy. But markets are constantly thinking this is all going to go away. Trump will wake up and realize that everything is about markets. Everything's about them. It isn't. The entire fundamental structure of the US economy is trying to be changed, which will change the world economy, which will change markets. And let me just conclude with one little anecdote to summarize it. I've said this again and again to people. When you move from economic policy, which is all about give markets what they want, or because markets, to economic statecraft, which is all about national security and foreign policy objectives, you shift from asking what is GDP, as in 1.9, 1.8, 2.0, which markets speculate on. Right? There's a whole industry of people speculating whether it's going to be 1.8, 1.9, 2.0, making money when it comes out and it's slightly higher or lower, as if that tells you anything. But that I can't tell you how much money goes into doing that, right? And we call this rational allocation of capital. We move away from that to asking, what is GDP for? What's it for? What am I trying to do with my GDP in every aspect? What are my fundamental principles, my targets, my goals? And if you can't say anything more intelligent than because markets, what the hell are you doing running a country? And I would suspect that either you won't be for long or your country won't be doing very well for very long. So in that environment, the market will still always have a key role, because the pricing transparency is incredibly important. That's what destroyed the Soviet system. You have to have pricing transparency, but you also have to have recognition that some things are more important than markets. Sometimes price isn't everything. Raising a child is incredibly expensive. Do you actually get a financial return that's commensurate with that? No, I can assure you, you don't. There's no financial return commensurate with raising a child. Is it therefore rational to say let's have no children? Well, you're actually seeing that in demography in country after country, because we're all thinking because markets. That just means you don't have any future for the country because there are no children. So certain things trump pure financial thinking, and I think Donald Trump is one of them.
Yeah, so I guess what I hear from that is that the S&P is not going to go up 20% a year, every year, forever, like some people would like. But to be more serious, I think with what you're saying about a economic restructuring and certain different parts of the population being more favored than just the Wall Street ivory tower types and the DC parasites, I guess is the way I'd put it. Might be too kind, honestly, but anyway, the way I kind of see the restructuring happening in the U.S. is if they get it right, then you're probably going to see a middle class that is starting to revive itself, and maybe the upper class that owns assets is not going to be as thrilled with their returns. But I think that probably leads to a more healthy outlook for the country as a whole, where the way I kind of look at it is that the path we were on up to this point was unsustainable, and you kind of see it with some of the different divides across society, whether it's the generational stuff you see on Twitter where people get in constant fights where like everyone's slinging mud at the boomers. Boomers are telling everyone else to pull themselves up by the bootstraps, all that stuff. But I think those divides are pretty interesting and something that needs to be resolved at some point if we want to move past this. But as far as the kind of outlook for, okay, how does this flow through to equities or bonds or commodities? Are there certain asset classes you think will hold up better in this restructuring period?
Well, look, first of all, let me address the point that you raised. I agree. Logically, again, without making a forecast, that's exactly what has to happen. If you're going to deal with the inequality within the US and remove that socioeconomic polarization and political polarization too, by the way, then yes, those who have done well in globalization will do less well. Those who have done badly will do better. There's no way logically it can be anything but that, if it is to succeed. If. And at the same time, logically, because balance sheets move from the national to the international, that means that the big net exporters like China have to be exporting less. And the big net importers like the US have to be importing less. So necessarily the trade war is part of the class war, as Pettis and Klein said in their excellent book on that subject. What does that mean for markets? Well, first of all, as you said, it doesn't mean you just assume stocks go up 20% every year. Does it mean stocks won't go up? Well, no. I mean, there would still be growth. Companies will still be making profits. But I doubt that you make excess profits of the kind that have been made so consistently for so long by, well, I would say, some would say so many and some would say actually so few, but by enough companies. Equally, I think that there will have to be a political mandate, which I just alluded to say you're making too much money in that sector, which comes down to restructuring in terms of antitrust actions, which you're also seeing. You saw under Biden, and you are seeing them continue to a degree under Trump, where you need to have more competition within the economy. So that's better for everyone, but it's not so good for corporate profits. But in between asset classes, it's difficult to say because it really depends how smoothly this plays out and in which geography we're talking. Because like in an ideal world, let's say this is the dream scenario, equities are obviously going to have a bad period now while this all happens. And after that, hopefully you get some kind of reshaping of what the stock indices look like to shift towards more domestic consumption rather than production in China and domestic consumption. So a rebalanced portfolio, shall we say, which provides you with a steady return. Let's say, purely hypothetical number, 7% a year. That doubles your money every 10 years. If you do that and you start saving as a young person, you should be able to retire on that, particularly because that would logically be commensurate with lower asset price growth. And I mean other assets like housing, for example, because in these kind of economies, it shouldn't be about wild speculation, just pushing up the price of one asset or another or another. So that, that might mean a moderate growth there. But equally, you could have a situation where things get really ugly, the transition doesn't work well, and stocks just tank and don't pick up, like Argentina style. That could happen. From the bond market perspective, the dream scenario is that yields come down because initially you have inflation as you onshore. Then you start making stuff again. And you can actually produce things at higher volume locally with different technologies and automation. Prices come down. So you get a one-time price shock and then everything levels off. Low inflation. Not as low as it was, but from China, but at least steadily around the 2% level. At which point the comfortable sitting level of bonds depends on what the international comparison is as well to a degree, but something hopefully around where the nominal rate of growth is. Like if you have a non-asset based economy, why can't you have a nominal interest rate that's the same as nominal GDP growth? So maybe you could have 4.5% Fed funds or something. And that's actually a comfortable level for everybody rather than an uncomfortable one, which would reward saving rather than consumption. But the shape of the yield curve, of course, depends as well, whether people do or don't have confidence in what's going on, whether you do or don't have a politicized central bank, and whether the government is or isn't able to deal with the excess debt overhang that it's currently got. So there are all different permutations of what happens to the yield curve. And then in terms of commodities, this is massively inflationary for some commodities, and it's massively deflationary for others. And let's take a key one, the energy complex. If you don't have cheap energy, you don't have anything. That's something this White House really does understand. And everyone thought they were going to come in and say, drill, baby, drill, which of course they have. And the energy complex is pretty shocked by the fact that Trump clearly wants to have oil around $50 a barrel, which doesn't make any money for most of them. But I believe he's starting to see energy the way the Chinese do, which is this isn't a sector that's supposed to make any money. It's supposed to just cover its costs so that you can actually do more practical things with the rest of the economy, like reindustrialization or defense production, or more money in consumers' pockets to buy products made in America, which might be slightly more expensive to begin with. So then how do you compensate that sector? And that becomes economic statecraft again, where what out of the box, because markets thinking do you do to make it worthwhile doing something without nationalizing it? Because America doesn't want to do that the way China does. But equally, you can't just let it be the private sector saying, well, I'm making great money here in commodity sector X upstream, and everyone else downstream is suffering. But hey, that's capitalism. Because I can assure you, when you're up against a planned or a semi-planned economy like China is, and it's a fantastic fusion of the dynamism of the private sector with the state support system that we saw under the Soviets. It's very effective in that regard. You can't win by saying because markets. If their attitude is we'll take a market share first, lose money for 20 years, and then we'll raise prices, you can't compete with that on a market basis. So again, that links back to what I was saying about bifurcation and whether people do or don't agree to these rules and in what geography. But I can't tell you clearly what commodities will do where and when, because it's so geopolitical. Each side will try and make sure within this shifting envelope of who's on whose side, who has enough of the key commodities. So who has enough energy to be able to make sure it's cheap? Because, for example, Europe wants to have cheap energy. It doesn't have any. So if Europe doesn't have any energy, they don't get to set the price of energy. Other people get to set the price of energy, either by turning off the green taps, if you're China, no solar panels for you, or turning off the LNG or the oil, which the US can do to them. So it's a geopolitical battle in which equities are currently going to be hit. Maybe there's a bright future for them, but it's not the future we've had, where 20% returns. I mean, how can you get a 20% return when GDP growth is like nominal 4 or 5? How can you keep that up? That's insane.
Passive investing and money flows, basically.
Exactly, money from money, which isn't real at the end of the day. The yield curve, open question. You can make an argument for higher yields, lower yields, steeper, flatter curves. It really depends on the scenario you're painting. And then in commodities, they're political. They're political. Some of them can go through the roof. Some of them can go through the floor. If they go through the roof, how long until you get a knock on your door telling you you've gone through the roof too much? Thank you. You've done too well. Time for you to do less well. If they go through the floor, how long before you get support from the government saying, actually, we need you to produce this at a loss? Because we have to have this. For example, rare earths. You can't market them versus China because the rare earths aren't rare, but the production is so polluting with so many environmental regulations. It's very expensive. That's why they're all processed in China. Well, as a result, the Pentagon can't get the rare earths it needs for F-35s. Are you telling me that's sustainable? Of course it isn't. So something's going to have to be subsidized, even though it doesn't make any business sense. So I've spoken for too long there, I think. I'll let you jump back in again. But it's a very, very muddy water that you're looking into. And it's very, very complex. And it's not a world where you can just say, where's the next big trade? Which is what we've been doing for 45 years. But that's gone now.
Yeah, I think, no, you made a lot of good points. And it's hard to pick any specific thread that I want to go into first. But maybe I guess the thing that I kept coming back to as you were talking about different things, whether it's bonds or commodities, is kind of the idea of capital cycles. And like if you get 40 years of declining interest rates, you're probably not going to top out after, say, 4 or 5 years of rising interest rates. And if you have commodity cycles that typically run 15 years, you're probably not going to see oil bumping around 50 for the next decade, especially with where I think inflation's headed. But do you have any view on how like the capital cycle and the cyclical nature of some of these industries and commodities and different asset classes like bonds, how they move? Like, does that feed into your view on where that kind of might lead things to go?
Not really. Not really, because you're considering a long run cycle theory when I'm saying we're going through a structural breakdown or a structural collapse, which I think will be a reset within many of those cycles. So in fact, if anything, the kind of cycles or waves I'm looking at are Kondratian waves, if you're familiar with that kind of old school thinking, which is entirely geopolitical. And in fact, if you look at long run inflation, it's intimately tied up with phases of war.
Yep.
And so are phases of debt. So I am looking at cycles. I'm just not looking at them in the way that a traditional economist would do, thinking that there's a 15-year peacetime kind of peak and trough. No, we're going through a complete structural shift at the moment, and that's obviously going to have huge implications. And it's unclear at the moment how they will pan out, because I think even the powers that be in each of the different locales aren't sure how to play it out themselves. Like, for example, how much more capital accumulation can China do? Realistically, I mean, they've had the most insane capital accumulation for a generation. So clearly they need less, but they can't grow if they have less. So what do? It's like a shark. It has to keep moving, right? Or it drowns. But that's not sustainable. And in the US, obviously, there's been massive capital underinvestment in many sectors, and clearly that's going to have to change with onshoring, et cetera, et cetera, et cetera. That's going to involve, as we used to say, guns or butter choices. And I think there's going to be a lot of that about. But how that can be done now that we have central banks, which can do QE whenever they want to, so we can produce the capital itself in terms of the money ad ridiculum, but we can't produce the physical goods ad ridiculum, and we can't produce the skilled labor ad ridiculum. That again becomes guns or butter. So I apologize if that's a very loose answer, but it's still, as I said, tied up with this question mark of what's the world going to look like as we try and feel our way through it.
Yeah, I think the way I'd put it, to kind of add on to your points, is it seems like almost everyone's flying by the seat of their pants. No one really knows exactly where this train is headed, but I guess the visualization of trying to assemble an airplane while you're flying it is kind of where we're at right now. But I guess
with some parts missing.
Yeah.
That's the problem.
Yeah, it's definitely on the extreme level degree of difficulty if you're looking at it that way. But one of the things, I guess, before we move on from China, I guess to pull on one of those threads you were talking about, the capital accumulation. And I was talking to a friend about their economy and the way it's set up, and he's kind of making some similar points. But when you look at some of the distortions from the overinvestment in manufacturing, obviously people have talked about like the real estate bubble and beating that dead horse for several years now. But how do you view that kind of overinvestment in certain sectors and where that forces them to go? Because I know everyone's kind of saying, oh, well, China's going to try and become a consumer economy. And one of the points my friend was making is like they're not going to be able to buy some of these goods at the same prices that people in the US would buy or people in Europe would buy. So how do you kind of view those economic distortions either resolving themselves or, I guess, playing out from here?
Well, first of all, just to clarify, tongue in cheek, when you said your friend was talking about their economy, I'm taking it we're talking China here rather than your friend's economy.
Yeah.
I'm not familiar with what their economy is doing.
Yeah.
Okay. Yeah. So the Chinese model, I mean, in the simplest possible terms, it throws capital at whatever it wants to throw capital at. And when it does that, it does it to an incredible degree. So they had the biggest property bubble in history, the biggest property boom in history. Then the government pivoted and said, look, homes are for living in, not for speculation, which I, by the way, think should be true everywhere. I applaud that statement. And then rather than saying we're going to have a hard downturn like Thailand did in 1997 or Japan did when their bubble burst, they just threw all the same capital and more into manufacturing. So then, of course, what was already a manufacturing-dominated economy became an even more manufacturing-dominated economy. And that's why they're now flooding the world with EVs, et cetera, et cetera. Clearly, they make too much stuff for their own good. They can't consume all of it. They will not be able to absorb all of it, realistically, in any kind of foreseeable time frame. And above and beyond that, they have openly said in report after report, working paper after working paper, they don't want to be a consumption-based economy. They regard a consumption-based economy, which historically, as we see with the US and as we've seen with country after country before it, drifts towards running trade and current account deficits, because you sit there and say the world provides us with goods, you make them, we're the center of the world as a consumer, where the US sits now. They see that as ruin, cultural ruin, economic ruin, power ruin. They'll not do it. I mean, I've made this joke before. The Communist Party flag with the hammer and sickle. I'm sure you've seen it, even if most Americans are no longer familiar with what the hammer and sickle are for. It's not a TV remote control in a gin and tonic glass. It's not a consumer-based underlying ideology. It's about production. Marx was all about production. So we can make the argument China has to become a consumer, which is what the US has openly said it wants it to do and will help. I think it's offering carrots as well as sticks. But, those who know China very well are very, very skeptical that can actually stick for ideological reasons in exactly the same way. And it's a rather crude analogy that, you could say, country X needs to do Y, which is just culturally inappropriate to it. If you had a culture which is incredibly shy and retiring and you said you need to specialize now in loud, noisy parties with, lots of drinking and blaring karaoke, they'd say, well, that's not what we do. Well, that's the only way you can, resolve this problem, but it's not what we do. Where that leaves us, though, again, raises more questions than answers. Because if the world is an integrated balance sheet, the fact that China keeps overproducing means other people have to overconsume. So in the near term, the US is clearly saying we don't want to, the hardest way it can. If we see in the next 3 to 6 months Europe doing something very silly, which is entirely possible, and saying because Donald Trump offends us, we're going to go with China, either actively or by default, and don't rule that possibility out, because European companies absolutely are capable of making that kind of geostrategic error. Besides the fact
same with their politicians too.
Yeah, well, absolutely. I mean, it's a universal truth that politicians and large companies don't ask what is GDP for. That's not being asked in the West. But let's presume they did. Besides the fact, that would make the US an adversary, rather than just someone who is currently disagreeing with them over tactics and strategy. It would actually be an open adversary, which Europe cannot wear and do well. But China will immediately turn around and see Europe as the market to flood with all their goods. So Europe will start running an enormous trade deficit with China. Industry after industry will shut down. The reliance on China will only increase. And then Europe will either have to do what the US is doing now, a few years too late, which is exactly by what they're doing on the military front, exactly what they're doing, trying to shift from policy to statecraft, years too late, and just copying the US. But China will try and do that. But if that can't work, if Europe doesn't make that error and says, no, we'll go in the US bloc from the beginning, who is China going to sell it all to? And then you have to say, well, logically, they have to reflate, which I think is what the US is trying to force them to do. But if they don't want to, where the conversation then goes becomes rather awkward, because we had similar dynamics in the mid-20th century, trying to force one bloc to change its behavior. And it can get, as they say, geopolitical. And if it gets geopolitical, then it's all about who's producing more stuff right now, because you're going to need all the stuff you can get. And the US doesn't produce enough of it right now.
Yeah, no, I was talking with a friend. He's more up to date on what's going on with drones and the whole drone industry. I think China has I think, roughly 70% of all the capacity for like military spec drones and effectively the whole consumer market for drones. So that's a technology I think is going to play a bigger role moving forward. But I think what you're kind of saying there is kind of the perfect segue into what's going on in the rest of the world and potential for flare-ups or hot conflicts. Like we've talked about economic statecraft. Does this develop at some point into something more than that, where it turns into like a hot conflict and things between, like, people say Taiwan is like the pressure point in Asia, right? You've got the Middle East, which I see so many conflicting stories about negotiations with Iran going well, going poorly. I mean, I don't know what to make of that. And then obviously you've got Ukraine and Russia and what Europe is at least gearing up to do, as far as I can tell. But where do you think all those, or any one in particular, start to lead if things do start to get more chaotic and more, I guess, actually go kinetic?
Well, they are going kinetic. We've already got several of them. I think the best way to understand this is to see that everything is linked. And you have an emerging constellation on one side, which is very clear, and a less clear constellation on the other, which is shifting now, particularly in terms of what the US is deciding to do vis-a-vis Russia and Ukraine, which has really freaked Europe out completely. But you have seen the war in Ukraine on one hand, you've seen the actions on October the 7th and the war in the Middle East on the other. That's obviously linked to Iran, and the Houthis in the Red Sea, which is, part of the same cluster of conflicts there. You've got Taiwan, you've got the South China Sea, you've got various flashpoints there. You've got, as I'm speaking to you today, India and Pakistan actually fighting now in Kashmir, following the terror attack a couple of days ago, and India turning off the water to Pakistan. So you have flashpoints already. You have North Korea occasionally as well, threatening to do even sillier things than it normally does. And without scaring people, I mean, obviously this is worrying, and obviously there are genuine risks of a conflict there. That said, the US strategy appears to be pretty clear. De-escalate vis-a-vis Ukraine, or at least let Europe do all the heavy lifting. So Europe would be rearming itself aggressively, taking the burden off the US. It defends Ukraine. Russia is rearming, but hopefully you don't get a war between the two. But the US at least gets to go home and let those two sides look after each other, or face each other down. And the US can at least try and be friendlier with Russia and put it away from China's orbit a little bit if it can. And I've made the joke that, of course, is a reverse Nixon or an inverse Nixon, as people have said. And I've been calling that a Noxin, which is his name spelt backwards. But I've said it won't work because it starts with no and it's got she in the middle of it. So, remains to be seen if that will work. The Middle East, the US obviously wants to lead there too, obviously, as it has done for a long time. But it wants to leave it in a position where it still has control over the energy resources there. And so to do that, it needs a new extension of the Abraham Accords and some kind of peace, which means you have to deal with Iran and Gaza. And then if you can somehow get Iran into a deal, the suspicion is it's going to be a bad deal, which Israel won't like. But that wouldn't surprise me that the US will go that route. Because then Saudi can maybe normalize with Israel. I mean, Gaza's an absolute mess, but it can perhaps be resolved. If Saudi decides it can be resolved a certain way, the rest of the region will probably follow. And it wouldn't be perfect by any means, but that might sort that region out. And then the US can pivot everything it's got towards Asia. India and Pakistan, of course, is the latest one, where maybe that's attempting to destabilize the link between India, Saudi Arabia, Israel, and Europe, the IMEC, the India Middle East Economic Corridor, which would link Europe to India as a low-cost production base to encourage them not to deal with China, and give India a link through Europe, to different export markets and into the Middle East. And then that lets the US focus everything on Asia and try and get everyone to put up the same external tariff and the same security umbrella against it. There are a million ways that could go wrong, but you can see what the strategy is. Whether it will work or not remains to be seen. And the risk is that each individual section of it falls apart. So Noxin doesn't work. Russia and the US remain daggers drawn. Europe doesn't cooperate with the US the way it needs to, and actually becomes more antagonistic or just useless, which becomes a drain on everyone. Iran won't play ball, and or Israel goes rogue, one or the other. Although I think that's far less likely with Trump in office. At which point, yeah, you've got war in the Middle East too, and then you can't have any normalization there. Pakistan and India escalates. Not any kind of forecast, but again, that would knock aside the opportunity for the US to integrate more deeply with India for a while, just because why is anyone going to invest there when there's a war going on nearby? Just as they need people to be investing there more than leaving China. And then, of course, as I said, China can go geopolitical in East Asia. Not a forecast, not saying it will, but if it does, what does that do to your supply chains when you're still relying on stuff from there for now? So the world is about as uncertain as you can imagine it could be, even if there are putative efforts being made to restabilize it again. There are lots of forces in the East and West that would like to keep destabilizing it.
Definitely a lot to think about there as far as trying to put the genie back in the bottle, I guess is the way I'd put it. I guess the way I kind of phrase it is that going kinetic, I guess the way I'd put it is, do you think like the US gets directly involved in some of these? I know it's kind of been proxy wars, like Cold War type attitudes towards some of this. And I know that obviously what's going on in Ukraine is not just the Ukrainians fighting, they have support and all these different things. But do you think there's direct involvement there? Or do you think that the US starts to pull back and focus a little bit more on North and South America, like you've seen with talk of Greenland, talk about Canada, which has an election, I think, coming up actually next week now, but talk about the Panama Canal. Like, do you think that the US is going to be able to kind of pull its focus closer to home and kind of pull out at least as cleanly as possible from some of these international areas that you kind of just laid out there?
Well, yes and no. The Monroe Doctrine is a given. I was flagging that back in November when Trump won. There's no way that they won't do that, because that makes every sort of sense in the world. And it's actually pretty low cost, very high return. So let's take that as a given. How far down into Latin America you go, how hard you want to squeeze people to change, like Venezuela, potentially Brazil, who wants to deal with China. That's the question. There's turbulence there potentially, but I think that's a relatively low-hanging fruit for the US. They're going to leave Europe. That's going to happen. The question is whether Europe are prepared to grow up and actually organize themselves without them, or be disorganized and splinter as the US and China and Russia try and play people off against each other. Hopefully united and hopefully with some US logistic support initially, but that seems to be a given. The Middle East, the US is absolutely going to draw its forces down there as well over time. This, I think, is like the last effort. They're not going to get involved in a war with Iran, I don't think. They might support Israel doing that to a degree, in a worst case, but there aren't going to be boots on the ground. So that leaves Asia. Oh, sorry. Well, in India and Pakistan, the US is not going to get involved directly there either, but they could support India, and that wouldn't surprise me if they do that. And I think that would be a way to ensure you get a trade deal with India, by the way. The stronger countries back them now over this, the more likely they are to sign up to a trade deal in the next couple of months. So then that leaves East Asia. I don't see the US retreating from that. Taiwan itself, of course, is a very tricky issue, because if Taiwan doesn't want to fight, and Taiwan's doing nothing to indicate it wants to actually fight, its national conscription is a joke. It's spending far too little on GDP on defense. The systems it's buying won't defend it if push comes to shove. So whether Taiwan itself is the pivot point, or whether more broadly in Asia, the second island chain or things around it are more important, is a live question. But the US isn't going to give up on Asia, because if it does, then Hawaii itself is vulnerable, and there's so much of the world economy there and world production that even with Latin America, the US would be vulnerable. The Pacific is just too open to it. So I think that's where the US attention will focus. It will be there on the fringes of the Pacific front, which of course is going to continue to create tension with China.
Interesting. So I'm kind of wondering where all this stuff leads, because there's, like you said, so many different pieces, moving parts, and like some people call it the fourth turning. You kind of talked about the Kondratiev cycle and all these different things that it's just really hard to game out where all this leads. And to go back into what other people talked about, whether it's cycles of fiat money, like gold being remonetized, I think that's one of the things where some of the recent moves in gold and what's been going on there has a lot of people, I think, spooked. But I don't know if that's something that you're kind of thinking about as far as where that goes, because I know there's been talk of remonetization or kind of a neutral trade asset that people use. But I know China's got, what, 20,000 tons or whatever it is, whatever people guess is probably on the low end. But how do you view the role of gold and other commodities potentially being important for the monetary system moving forward?
Okay, well, gold itself, the movement we've seen in it recently, is a clear indicator that even if people don't understand how, they understand that things are changing dramatically and they don't feel comfortable with it. The volatility we've seen in it just this week, as we're speaking, sharply up and then very sharply down, points to that instability too, that you've got something that's supposed to be a safe haven trading like a penny stock, which is just ridiculous, right? In terms of the broader issue, the global structure and balances I'm talking about, where you've got big exporters and big importers, points to the fact that you do need theoretically a neutral reserve asset rather than the dollar, which is the reserve asset of choice, which is why the US runs those deficits. Everyone demands them and they have to get sucked out via trade into other people's pockets. So that's well known by many people, even if it's not accepted by most economists, who are like fish swimming in water that they just don't see. But there's no way the US is going to go to a neutral reserve asset, in my view. I understand people are passionately in favor of this. If you're a gold bug, you've always been a gold bug, and you will always find a rational argument why. My view there is that if the US goes to gold, then the amount of power it loses in doing that is absolutely staggering. Commodities won't be priced in dollars anymore if that happens. The dollar will collapse in value. Yes, the renminbi will go through the roof if that's pegged to gold too, if that is now the global reserve asset. But you would shift to being a massive net importer, reliant on a country which still owns all the physical physical supply chains, owns all the physical supply chains, which is not about pricing signals. So, for example, were that to happen and suddenly China is very, very uncompetitive, it would just increase subsidies, or it would just use statecraft to ensure that no one could manage to get hold of the intermediate goods or the upstream goods that are necessary to rebuild a supply chain to challenge it. It would use gunboat diplomacy where it could to make sure that you can't just say, hey, we're the US, now we're cheap, we'll get industry back. So it's completely geopolitically naive from people who think they're very geopolitical to presume that just going on gold with a massive trade deficit suddenly makes you strong again. No, it makes you very, 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 very weak until you've got the industry. Now, you can say, well, until we manage to get the industry back, we can't get strong, and we can't get strong and get the industry back while we're on the dollar. Okay, that's a different issue. But then my view there is that what you will actually see vis-a-vis this gold revaluation, I don't know if it will happen or how it will happen. The way it's being floated and linked to issues like crypto too, is that I think we may see something of the following. The umbrella I'm describing is we are using what I call financial fartcraft, because it's financialization and money from money, which is financial flatulence, effectively. So fartcraft to try and pivot to warcraft. Let me give you just 3 examples. So first of all, if you do the gold revaluation with saying, okay, the treasury gold holdings are revalued X higher. Okay, you can borrow against that immediately, or the Fed can do some kind of creative policy action against that, which gets plowed into the Pentagon as a one-off shot in the arm, or some kind of capital injection into physical supply chains. So it's fartcraft into warcraft. If the US is going to try and shift towards stable coins as some kind of crypto commodity, which is definitely up there, they're talking about Bitcoin, etc. as well. Maybe even buying Bitcoin with that gold, and that's the intermediate step. If they're going to do that, they're going to insist the dollar is the only access currency. So we're going to provide you with a hard asset, but you have to have our dodgy soft asset as the key to get to it. So you again ensure that the dollar still has to be kept as a liquidity preference, even if it isn't a reserve asset. You're trying to square the circle. You're trying to have your cake and eat it. And one last example. Let's say you have the US Sovereign Wealth Fund they're talking about launching now. Any economist will look at that and say, how can you have a sovereign wealth fund? You haven't got any savings. The government runs a deficit. The US runs a deficit. You have no wealth. Well, that's thinking in terms of policy. In terms of statecraft, what you are going to do is say, okay, here's a piece of land somewhere in the US, which has never been touched, beautiful mountain somewhere, federal government land, that's worth $6 billion, we say. We're going to go to Wall Street and tell them, no more because markets because us, and say, we're going to borrow 10 times that money. You're going to lend us that money, very cheap, in this sovereign wealth fund. They'll say, fine, you take $60 billion and you give $1 million to everyone in Greenland. Every man, woman, and child. Suddenly you own Greenland, well, one way or another. I would posit Greenland is worth a lot more than $60 billion. And you can get a decent return from that in terms of the location, the commodities, the warcraft component, maybe even a skiing resort, which is not warcraft, but there you go, a cherry on the cake. So if you do that, I think there are ways in which commodities of various sorts will be transformed, but it's the inverse of like the Norwegian sovereign wealth fund, where they take a physical commodity like gas, sell it, bank the money in the central bank, take that cash, and then buy a financial asset around the world as their savings. The US is going to start with financial fartcraft, use the legacy power that it has to do that within a financialized economy to buy the hard assets for warcraft.
Interesting. Kind of the backing their way into having some of the things that we would potentially need for this. I know you mentioned like state parks and some of that stuff. There's been talk about the, was it ANWR, Alaska National Wildlife Refuge or whatever, and the oil that's in, I can't remember how many, but it's supposedly like billions of barrels. So that's something that I think would be interesting, but obviously not an overnight project to develop that. But as we're starting to wrap up here, is there something that we kind of skimmed over or something we may have missed as far as other stuff that's going on or other things you're kind of paying attention to as far as all the stuff that's been going on lately?
Well, it's like that great movie from a few years ago, Everything Everywhere All at Once.
Yep.
Which is exactly what I expected this year to look like. I didn't want to use that title because I'd already used it previously and everybody else had because it was so catchy. I actually called this year, last summer, in advance, the year of living dangerously. And I said we're going to have a series of stackable binary geopolitical outcomes, each of which has such staggeringly diverse implications for where macroeconomics and markets will sit, that making any kind of medium forecast is a fool's game. 2% could be 6% or -2. And that's absolutely where we sit right now. And until we get the idea of where everything sits eventually, which, as I said, is a question of which geography does it sit within, and then what rules have to be imposed within that geography to make that geography impermeable to certain goods and capital from the other block, which is damaging to it, and permeable to things which are good for it, we simply won't know where anything sits. And just understanding that, just being confused, just having that kind of discussion will already start to give everyone who's got a granular view of a certain industry they're in or a certain area they're in the ability to then see what's likely to happen. What are the outcomes? It could go A or B or C, and then you make a probability weighted decision yourself, or you sit out and wait a bit longer until it's A or B, and you make less return by doing it. But that's the only methodology you can use. Don't listen to economists waffling on about what their model says things are going to look like.
Yeah, definitely. The media credibility is definitely taking a hit, but that's another rabbit hole for another day, I think. I guess I do have to ask you my traditional closing question before I let you go, which is what book should add to my reading list? Can be history, finance, investments, or just anything you think would be interesting.
Wow. Okay, you've really caught me on the hop with that one, because there are so many books that I would recommend that are just so appropriate in different niches. But I would think probably the best overarching book right now to read is that Pettis and Klein one that I mentioned, Trade Wars or Class Wars. I think if
Okay.
you want a holistic, integrated macroeconomy to global economy view of where we are now and why we are there, that's the best one to start with.
Awesome. I'll definitely add that to the list. My reading list keeps getting longer and longer, and I'm sure I'll catch up on it eventually. But it'll be that one I think will be near the top, especially with all the stuff going on lately. If my listeners are looking to find you or find your work, where can they find you, whether it's social media or anywhere else?
Yeah, sure. So obviously, some of what I do is available on our home webpage for clients, which is Rabobank Knowledge. Um, Generally, you have to be a client to get access to all that, but some of the stuff is readable, for the general public. I'm on LinkedIn. You can look for me there. I'm not too active, but I am there, and I try and enjoy good discussions about these topics on X, where I am at the Michael Every. So just and then my name, all one word. And let's have a discussion about these things, because I learn as much from other people as they maybe learn from me, and I always like it to be a two-way process.
Yeah, the daily summaries that you put out every day or must reads, I definitely look for those at least once or twice a day. Try and figure out, okay, what all happened today. There's a whole bunch of stuff going on, and it's a pretty good short and sweet recap of everything going on. So definitely gave me a lot to think about, and I think same can be said for my listeners. I really appreciate taking the time. So I think with that, we'll be wrapping up. Thanks for stopping by, and we'll see you next time.